Welcome to the Base School. Today we're learning IAS8, Accounting Policies, Changes in Accounting Estimates, and Errors. Ever wondered what happens when a company changes its mind on how it calculates something in its accounts? Or what if it finds a mistake in last year's numbers? IAS8 gives us the rules. In today's video, we'll look at what happens when a company decides to change the way it does its accounting, like switching from one method to another, updates to estimates they've made, and even errors from past periods. What is IAS8 about? This provides the guidelines for the selection and application of accounting policies, treatment of changes in accounting policies, and adjustments of accounting estimates, along with the guidance for the correction of errors. It is designed to improve the relevance, reliability, and comparability of a company's financial statements over time and with the financial statements of other entities. Accounting policies. These are the rules, practices, bases, and principles adopted by the entity in the preparation and presentation of financial statements. For example, how do they value inventory? Do they use first in, first out, last in, first out, or weighted average? Occasionally, a business may choose to modify one of these policies. Perhaps they discover a better method that provides more accurate and relevant information, or perhaps a new IFRS standard requires it. If so, IAS8 requires that the company has to go back and adjust the previous figures as well. This is called retrospective application. The new policy is applied as if it had always been in use. That way, the numbers from this year and prior years can still be compared properly. Next up, accounting estimates. Due to the inherent uncertainties in business operations, many financial statement elements are best estimated rather than precisely measured. Estimates are assumptions taken by entities on the latest available options. When a company changes an estimate, we don't change the past. We just update it from the current year going forward. This is called prospective application. So if we thought a machine would last 10 years, but now we think it'll only last 6, we update the depreciation starting now. No need to restate past accounts. And finally, errors. Sometimes a company makes a genuine mistake. Maybe they forgot to include an expense, miscalculated something, or applied an accounting policy incorrectly, which occurs due to failure of use of information. IAS8 requires companies to go back and fix it by restating previous year's numbers and adjusting retained earnings. So, to wrap it all up, next time you see a change in a company's financial statements, ask yourself, is it a policy change, an estimate update, or a correction of an error? IAS8 helps us tell the difference. And make sure those changes are handled in a way that keeps financial reporting reliable, consistent, and transparent. Save this and follow the Base School for more simplified standards every week.